Friends, good day. In this video, top 3 option strategies for trading at the stock exchange. In the first place, I put a strategy that is very popular among beginners, selling naked options. So now the Bitcoin futures price is 28,660, hence 28,500 is the center strike. I suppose I buy a call option of strike 30. What happens if there is a price movement like the one that happened recently? Here, you can see it on the chart. The move started at 27,400 and the price reached 28,660, over 1,000 points. It would seem what's stopping Bitcoin from going up another 1,000 points? 1,500? 2,000? I think it's entirely possible. It's just a matter of time. What happens to our bought call option at strike 30 if the price rises above 30,000? Not at expiration, but right now. If we bought an option for 45 points right now, for example, 1,000 options is 1 Bitcoin. Let's see how much the option will be worth if the price of the asset rises to 30,000. Here in this line, I enter the value of 30,000 and we'll see the price has increased almost tenfold. It's now 412, a radical effect, while the Bitcoin price has only gone up by 1,500. And of course, we can't lose more than $45 in this strategy, but the profits will be, if the growth happens, $367. Plus $45 of our deposit. I talked about it in the video about account overclocking. It's a popular strategy that a lot of people use. And there are a lot of programs, scanners, screeners, that show options that have gone up a lot recently. Traders look at this and think that the options will continue to rise in price. But nothing like that often happens. It's wrong to think that way. It's just the way the business works for people who want to get people to take the bait. I do not recommend using a strategy with the expectation that the assets will rise or fall immediately again, because it's chaos that decides whether you're lucky or unlucky. And if you want to use series options with a short expiration, for example in a week, no matter call or put, and you expect Bitcoin to fall sharply below 27, you can buy additional leverage. For example, put options are cheap for $23 or $24. This is the strategy you can use if you expect the price to fall from 30 to 27. And even if the price drops, the options will be 15 times more expensive. Insane profitability if you manage to catch a sharp rise in price. But it is very difficult to catch these movements, and frequent use of this strategy often leads to losses. This strategy is better to use when you notice some aggressive trend, but do not forget that volatility increases when the price changes. The strategy can bring big profits, but it comes with big risks. You can lose the premium you paid for the options, but you cannot lose more than that. And that is a good thing. It was a top 1 strategy, popular for beginners who expect x10, x1000 profit, and they have that opportunity, but it is very hard to catch the moment. Number 2. Let me clear the work field first. Number 2 in popularity, I consider option selling volatility to earn a time premium, also known as a strangle. So let's take a longer series, a monthly series. Put options at strike 27 and call options at strike 31, which we're selling 1,000 here and 1,000 there. You probably know the strategy very well. Beginners sell naked strangles, expecting the price to stay within limits. And then they face the fact that price does go beyond the strikes. They get risks, and they fix these risks, mistakes, experience, new knowledge. And then beginners apply rolling, in whole and in parts, as well as delta hedging. These measures can be applied at the beginning of the launch of the strategy or in process, such as delta hedging with an automatic launch when the price approaches a certain level. What are the pros of the strategy? It has predictable returns. Yes, the margin requirements are large, But returns are not small either. Strangle's return is 5 to 10% of GM in a month. But over the course of a year, sometimes the return is over 100%. I have a whole video devoted to selling options and delta hedging. The most important thing to remember is that the main thing in this strategy is risk management. And the third most popular strategy is the vertical spread. Many people come to trade options because of the opportunity to limit losses and lock in profits. Stop loss and take profit. And this will give you a vertical call or put spread. Stop loss means that we can't lose more than the premium paid. And take profit means that the trader immediately understands how much he can earn. Therefore, it is possible to eliminate the human factor and the need to create limits manually. Vertical spreads have very good financial leverage and are very cheap. Spreads can be used if you believe that the price will not rise or fall below or above a certain level. And that's my top 3 strategies for options trading. If you have your own opinion on this, let's discuss it in the comments. Give this video a like so other traders could find it. Subscribe to the channel if you haven't already. More interesting videos will be coming soon. I wish you good luck and successful options trading.